Imagine waking up tomorrow to discover that nearly $41 trillion, almost twice the entire US GDP, could evaporate from global markets in a single night. Investors are gripped by a chilling question. Are we teetering on the brink of the most catastrophic financial meltdown in modern times? Recent weeks have seen markets wobble as global capital flows grow unstable. But Bank of America's latest analysis has magnified fears exponentially. Their report warns that $41 trillion in global wealth faces rapid devaluation. It's driven by a convergence of economic and geopolitical pressures accelerating beyond predictions. Historically, the dollar and U.S. debt were bedrock investments. Yet soaring national debt, aggressive interest rate hikes, and worldwide political chaos are eroding that trust. When institutional giants like hedge funds and sovereign wealth funds reposition, the aftershocks can be catastrophic. A sudden sell-off could ignite chain reactions through equities, pensions, and banks, morphing from a Wall Street crisis into a Main Street nightmare, shrinking retirement accounts, spiking mortgage rates, and eroding the dollar's buying power. This $41 trillion vulnerability isn't abstract, it's anchored in four critical risks. U.S. debt overload. Federal debt now exceeds $35 trillion, more than America's annual economic output. With interest rates high, debt servicing costs are ballooning. If major bondholders like China or Japan retreat, borrowing costs could explode globally. De-dollarization surge. BRICS nations China, Russia, Saudi Arabia increasingly trade in local currencies or digital alternatives. Each non-dollar deal weakens U.S. financial hegemony, threatening demand for Treasuries. Geopolitical Tinderbox. Trade wars, sanctions, Middle East instability fuel investor flight toward gold and crypto, abandoning traditional markets. Shadow banking peril. Unregulated entities, hedge funds, private equity control, trillions. A single liquidity crisis among them could trigger a 2008-style domino effect, but globally amplified. Imagine the first tile falling. A mass Treasury sell-off crushes bond prices, spiking yields. Borrowing costs surge for governments, businesses, and homeowners. Next, pension funds packed with stocks and bonds lose billions overnight, vaporizing decades of savings. Banks and shadow lenders, overexposed to risky debt, face margin calls and fire sales. Emerging markets, despite diversifying, aren't spared. Their currencies collapse as capital flees. Ultimately, everyday life fractures. Layoffs multiply, prices soar, and banks restrict withdrawals. Once panic sets in, the system could implode within days. The Federal Reserve could slash rates or inject liquidity, yet stubborn inflation handcuffs its response. The U.S. Treasury might guarantee debt or orchestrate bailouts. But with $35 trillion in existing debt, this risks deeper distrust. Global coordination, for example, IMF, ECB, could stabilize currencies. But geopolitical fractures make cooperation unlikely. Prevention is the only reliable shield. Curbing U.S. deficits, mending trade ties, and forging capital flow pacts with BRICS. Without these, even emergency tools may fail to contain a $41 trillion avalanche. Bank of America's warning is a siren call. Decades of debt. Rivalry and fragile confidence have primed the system for combustion. Optimists argue markets will adapt, noting strong corporate earnings and lessons from 2008. Pessimists see a debt-saturated edifice when it crumbles. Families, retirees, and small businesses will bear the brunt. The coming months are pivotal. Watch how the US, China, and BRICS navigate currency shifts and tensions. One misstep could unleash chaos. This isn't distant finance, it's about your savings, your loans, your livelihood. Stay vigilant, stay informed. The $41 trillion threat isn't just a headline. It's a storm cloud darkening every wallet on the planet.